Today I just want to go through a brief sort of description of how we see the current macro environment and how we've positioned the portfolios, and then feature one of our key clusters and a company representative of our process. Today, in most portfolios, in the typical passive or even active portfolio, you will have an exposure to a lot of growth stocks because they have been the stocks that have been outperforming. Quality growth has been the most persistent style of the post-GFC environment in terms of outperformance. And then secondly, there's been one story in terms of domestic growth, and that's been the US economy. So if we strip out all the multinationals and just look at some of those old world stocks, retailers, utilities, telcos, property stocks, banks, they represent half of the US market, and the US market is half of the global index, roughly. So 25% of the market, 25% of your passive fund is exposed to US domestic economic risk. So the question is, investors should be asking is, how does the US cycle look? So there have certainly been tailwinds. The typical US corporate today pays a 20% rate of tax. So a lot of the improvement in ROE has been a combination of tax cuts, improvement in the consumption environment as well. Second or thirdly, you've just had the leveraging process. Some of the weakest companies, the most poorly positioned companies, have been able to access very forgiving corporate bond market. And then you've had the disruption, and disruption is actually arguably turning the environment into one where it's very interesting to us in one of the most innovative, dynamic periods of technology deployment. Very few companies are going broke. So what is happening? Those companies are getting bailed out by private equity and very forgiving debt markets. So we've got a lot of disruption, but we don't have anyone who seems to be suffering because of the disruption. You see these dynamics elsewhere in the world, but elsewhere in the world, that same group of stocks is about 30% cheaper. And then the question is, are the economic cycles in sync? Where is the dry powder today from a fiscal perspective? Now, the US could take the 3.5%, 4% budget deficit and go again. We have no doubt that populism will mean that most politicians will reach for the fiscal lever when they feel like they're under political pressure. So where are those politicians under the most pressure today? We would argue Europe. Europe is in rude fiscal health. We've had a decade of austerity, and that is potentially coming to end. Christine Lagarde, as the new president of the ECB, is a potential game changer. With all due respect to the economists in the room, she's a politician, not an economist. She will be able to, I think, get a much more coordinated fiscal response, which will reinforce Europe's very loose monetary policy. Now, we need to get through Brexit, which is very convenient for Europe because it's leading to an ongoing devaluation of the euro, which feeds back into their export competitiveness. So we think in the US, tailwinds are potentially becoming headwinds. That 25% of the market is under disruption pressure. So be careful in your stock selection. Those pressures are elsewhere, but the stocks are potentially a lot cheaper. Now, the second issue is just the exposure to growth and quality in most people's portfolios. So what has driven the outperformance of these stocks? Well, there's no doubt the very large tech platform companies have delivered earnings growth. They've delivered innovation, and they've re-rated. But there's also a lot of imitation taking place. You think WeWork, it's a serviced office operator that now is one of the largest landlords in most CBD locations. There are many companies that are potentially not innovating, but they're imitating something that is very, very simple and hence will be exposed to competitive pressures. Why have investors crowded into growth and quality? We would argue it's a simple outcome of the discount rate. When you lower discount rates, companies that have the promise of future cash flows will re-rate much more sensitive to that falling discount rate than companies that are not growing and have cash flows today. Now that can work in reverse. So just be aware of that. So what have investors been chasing? You hear a lot of discussion around yield chasing. No, they're chasing duration. If they were chasing yield, they would have a portfolio full of European banks because they are giving you 7% dividend yields on 50% payout ratios with capital buffers. And in the case of ING, with a very strong retail franchise. So investors are chasing duration. When you have $12 trillion of negative yielding debt, that's not surprising. How does it end? Well, even within that duration chasing, we still have the phenomenon of the industrial production cycle. We still have economic cycles. And as you can see, on the orange line, industrial production has been weak. And hence the US yield curve over the past 12 months is flattened by around 100 basis points. So that drove that duration chasing into overdrive. I would argue with industrial production appearing to be at the bottom and ready for an inflection, that's potentially not the time to go in on duration. There is the potential for some of the rate cut expectations in the US yield curve to reverse. We don't think we're going into a recession yet. So as that reverses, the question you need to ask is, how are cyclicals priced? If growth is expensive, how are cyclicals priced? Cyclicals are priced for something worse than the global financial crisis. Now, don't buy cyclicals because they're cyclical and they're on low PEs, but it could be an interesting part of the market to look for the next round of disruptors. Not all of these companies are broken. So I think a great example of a company that is tarred with the cyclical brush, that has a structural secular growth story to it, is Siemens. It is the classic German conglomerate. Now, to their credit, they have been trying to simplify the business, looking to spin out their transport business, spinning out their healthcare assets, and essentially doing the same with the power business. As they go through that slimming down process, this business called Digital Factory becomes a much larger part of the earnings profile. So what is Digital Factory? It is basically the software and hardware that you need as a manufacturer to take your product from conception through to final delivery to, in the case of Mercedes, basically you can design the car. You can even create something called the digital twin. So what is the digital twin? It's basically a virtual prototype that you can take around the racetrack. You can stress test in different weather conditions. And then you've got the hardware to actually go and manufacture the product, to lay out the factory, to control all the processes and deliver the final product. So there's a lot of software involved. It takes a very complex product, a very complex process, and makes it quite simple. Now, as you can imagine, there's a lot there. Now, the interesting thing about Siemens is the valuation. With half of the profits coming out of a very, very high quality business with growth, you are paying a PE of 13 times. Now, as you know, with the bubble in software valuations that we see today, that's quite cheap. Now, the other half of the business, we would argue, is not a bad business. Yes, it's a little bit more cyclical than Digital Factory, but making gas turbines in a period where carbon prices in Europe have never been higher, and there is going to be significant switching from coal to gas generation, that's actually not a bad place to be. So the cyclical business can recover. So we have Siemens as one of the key stocks in our cluster, which we call conglomerates simplifying, with the other major holding there being GE. So taking us to how we go around building portfolios at Antipodes. First of all, it starts with the research process, the stock picking process, where we're looking for companies that have a margin of safety and multiple ways of winning. Secondly, we layer on top of that a clustering process where we try and group the companies in areas of similarity. GE and Siemens will be correlated, as will some of our other industrial holdings. We may be able to find shorts where we can offset some of the cyclical risk. But those clusters, 8 or 9 on the long book and sort of 3 to 6 on the short book, will tend to have non-correlation to them. So we believe we can build a high conviction portfolio out of 60 longs, which are actually 8 clusters, which are non-correlated. Finally, there will be opportunities to look for ways to insure against tail risk. Unfortunately, the time to buy insurance is not when the house is burning down. It's when no one else is thinking about it. So it's today, high yield credit spreads have rarely been tighter. Is the high yield credit market in rude health? We would argue no. The problem with the high yield debt market is it's been those bottom 25% of companies that have borrowed. The companies that are under disruptive threat are the ones who have geared up their balance sheet to buy back stock. So you need to keep that on your radar. When we bring it together, it should deliver returns through the cycle at lower levels of risk ahead of the market. The last 6 months has been a tough period. The outperformance of growth at any price has made it difficult for Antipodes to keep up. I would argue, though, at this point in the cycle, it's not time to be all in on growth. Look for quality and growth in less obvious parts of the market where it may actually be cheap.